Hi, everyone. Welcome to this webinar hosted by Enerdata and Compass Lexecon. My name is Christian Mallard. I'm the head of marketing at Enerdata. And speakers today are Morgan Crènes, who's head of research and innovation with Enerdata. Hi, Morgan. You're muted, Morgan.
Good morning, everybody.
And also we have Yves, Thieis, who's VP at Compass Lexecon. Hi.
Hello.
We have about 120 attendees today. And as the title states, we're going to be addressing the European power markets. So as you all know, the energy prices have been surging over the past few months, resulting in lots of economic, political, and sometimes social turmoil. So the question is, what comes next? What comes next in the short term? What comes next in the longer term? And what are the implications on the energy systems? So this is one of the few questions we're going to be addressing today. So perhaps we can move on to the next slide. Thank you. Just to say that you can ask any question that you have using the Q&A button on your interface, and we'll be answering all those questions at the end of the webinar. So feel free anytime you have a question, just type in the chat box, in the Q&A chat box. Thanks. Just a few words as an introduction about Enerdata and Compass Lexecon, for those who don't know us already. So Enerdata, we're celebrating this year our 30th anniversary. We're about 50 people, and we're specializing in the analysis and the modeling of energy and climate issues. In other words, we help quantify anything that relates to the energy transition, both for government bodies and their policies and scenarios, and for energy companies as well, and development banks and investors. That's in a nutshell. Maybe you can move on to the next slide. So what do we do at Enerdata? What are our core competencies? Of course, is data science, modeling and forecasting, and research and intelligence. And we cover all the energies, we cover the emissions at world, region, country, and sectoral level, and sometimes down to the end users and the industry branches. Next slide, please. So I leave you the floor for Thierry for the short presentation of Compass.
Yeah, sure. So Compass Lexecon is an international brand, which is mainly a global economic and financial advisory firm with offices across the different continents. So regarding the energy sector in Europe, we've got 40 plus experienced consultant teams spread across multiple European offices, and addressing not only power market related topics, but basically global energy markets, as well as regulation, competition, and well, any matters related to economic questions.
Well, thanks. Yeah, and we decided some time ago, Enerdata and Compass Lexecon, to join forces because we got lots of questions from our clients regarding the forecasting on of the electricity prices. And as you know, there's some existing solutions on the market for that, but our clients kept asking us, we'd like to have some kind of let's say more independent view, or at least a different view, and something that's available off the shelves to start with. So we came up with the idea of creating a subscription-based information service named European Power Market Outlooks, covering not only the markets, but also the drivers. And to make a long story short, for each and every European country, we provide a detailed report with all the figures on the drivers, like commodity prices, supply and demand, regulations, market design, interconnection, and the projections themselves, both in an analytical and form and in a, let's say, in a data form, in an Excel format. And well, this service, this subscription-based service is available as of now. So what you're going to see today, the analysis that you're going to be, Yves and Morgan are going to be presenting, is a kind of an aggregated version of this IPMO service, aggregated at the European level. So this will give you a precise idea of the outputs that you can get in each and every of those reports. Next slide, please. Yes, so here you can see a few sample, outputs. But I mean, let's just view the analysis on Europe as a whole, and it will be self-explanatory. So yeah, Yves, I'll leave you the floor, please.
Thanks, Christian. So before diving into the flesh of the core of the webinar on the recent increase of power prices and underlying commodity prices, we wanted to just step back a little and just look at the more recent trends that have been observed, or the kind of the longer trends that have been observed in the commodity markets. So both for gas and CO2, just to set the scene and try to understand what are the drivers that explain the current price increase, and how long these drivers or these price increase would be sustained, and when do we expect the prices to revert, if we expect that to revert back to previous levels. So the first slide that we wanted to show is the historic prices for gas and coal since the last economic crisis of 2008, and featuring the past cycles that the different commodity markets have faced. And what we can see from these historical evolution is that, well, first, cycles are something that are already present for quite some time in the commodity markets. But second is that the frequency and the range or the magnitude of the cycles has dramatically increased over the recent years. So not only for, well, obviously for the recent price increase, but if we look at the rate of change of the previous sharp increase that the market observed back in 2017, 2018, the rate was already quite significant compared to what could have been observed in previous decades. So the cycling effect, the frequency and the magnitude of the cycles that the commodity market observed is something that is not new, but effectively we are going to look into the drivers that kind of underline the current significant sharp price increase that we could observe, well, not only in the gas and coal market now, but across the different commodities that would have an impact on the different energy markets. So maybe Morgan, you want to take the next slide?
Sure. Thanks very much, Yves. So now we will have a short focus on natural gas supply to Europe, and right after this, we'll go into the recent surge in energy prices. So if we look at the top left corner, we have a graph that plots the share of natural gas imports and consumption from storage, withdrawal from storage, over the total consumption of natural gas in EU and UK. And we can observe a big trend over the past decade. This share has been increasing by 25%. So this is significant. And what is behind this? Basically, natural gas production in Europe has declined over the past decade. And in the meantime, consumption was relatively stable. So of course, with some short-term cycles and variation in the power sector, depending on gas power plants competitiveness. It means that Europe is relying more and more on imports and is more exposed to key exporters. And this is especially the case for Russia, which accounts for 50% of total natural gas imports in the EU. And in the recent months, import for Russia, Russia respected its long-term agreement with Europe, but could have shipped a bit more natural gas. It was lower compared to the previous years, and this is one, and this put some pressure, upward pressure on prices. And one consequence of this is that Europe and UK relies more and more on storage. And on the bottom right corner, you have a graph with the amplitude of gas stock variation, and it's increasing. And if we look at winter months, when there is withdrawal from storage, we can see that variation is almost stable compared to beginning of the decade. But we have to keep in mind that this trend could be reversed in the midterm or long term if Europe manages this successful decarbonisation with improvement in energy efficiency. In winter months, buildings will need less natural gas for heating, and the variation, seasonal variation between summer months and winter months should decrease, and consequence would be less use of storage. Okay.
Thanks, Morgan. So basically, to sum it up, so what Morgan just said as two key consequences on the gas market. So first is the gas market is an international market, and so to analyze and to assess how gas prices would evolve in Europe, you need to look at what's happening in the other regions, and B, effectively, when looking at the gas price, you want to check how the European gas price compare to the cost of shipping from the US market, or the cost of the gas price in Asia, which would be a comparable benchmark for redirection or rerouting gas internationally. And last but not least, the storage impact as well. And so we'll see that it has quite an impact on the current situation. So if we now focus effectively on the recent years and months, and especially with regard to the recent price increase, we can see that European gas prices have significantly changed, obviously, and increased, as we all know now. But interestingly, it has remained in line with, well, first, below the Asian gas price, and B, as well, apart from the recent price increase, in line with the US gas price plus shipping cost. So what we wanted to illustrate on the chart that you can see on your screen is how historically the European gas price has evolved compared to these different benchmarks, and the three different phases, the recent phases that the European gas price has faced recently. So before mid-2018, so the price spread between Europe and the US has increased steadily. So driven by the tightness of the European hubs, to a lesser extent than what we are currently facing, as well as the Asian demand growth, and again, to a lesser extent to what we are currently seeing. But interestingly, what you can see is that while historically, well, it's start of 2017, the price, European gas price, was within the range of the shipping cost above the US hub price. You see that the European gas price has started to diverge towards the increasing Asian price. Now, in the second phase, what we've seen is a significant increase of LNG supply, with the commissioning of the first number of new LNG terminals, which had quite a significant downward effect on prices, both for Europe and for Asia, and which was then amplified by the COVID-19 crisis that basically come on top of the energy supply glut. So the COVID-19 crisis had two impacts. Well, first, basically increasing the glut effect on the international gas markets, and so you can see that early 2020, all gas prices kind of converged back to the Henry Hub price, and even in some instances, not to the same extent as oil, but reaching historically low levels. Now, at the same time, the COVID-19 had an impact on the next wave of LNG, and we'll review the impact of that later. But basically delaying the commissioning of the next wave and amplifying what we now all face, the impact of the economy recovery on the supply-demand balance, and basically just further tightening the different markets, leading to the third phase. So which has seen quite a sharp recovery, sharp rebound of all commodity prices. So first materialized early 2021, but mainly in the Asian market, and that's because it only materialized at the end of the 2020-2021 winter. So basically, the winter was mild enough in Europe so that prices would not converge to the Asian price. But now in 2021, given that the tightness has materialized before the winter, the European market is kind of following the trend, and we can see that they are now both significantly diverging from the underlying shipping cost plus Henry Hub kind of benchmark. Interestingly as well, so what we wanted to show as well on the chart, and it's kind of relevant for the European gas market mainly, is the range of gas prices, which would basically equal the economics of coal power generation in Europe. So given the decarbonisation objective of the EU, effectively you would expect that coal generation would remain more expensive than gas going forward. But given the recent gas price increase, what we've seen is that the CO2 price has not, as initially followed the gas price increase to effectively maintain the economics of gas versus coal, but since late August, the CO2 price has not increased sufficiently for gas to be more competitive or as competitive as coal. And we are now in a situation in which basically gas is much more expensive than coal to produce power generation. And thus, despite the fact that effectively the decarbonisation objective is on top of the agenda at the EU level and had quite an impact on the carbon price. And so we'll effectively review the implication of that additional finding. So if we deep dive on the key elements explaining the recent gas price increase, so for the third phase, so it's obviously first the COVID-19 recovery, which have been sharper than expected, and basically led by the aggressive global monetary policies. Second is effectively the sustained Asian LNG demand, and the fact that given the low prices during the pandemic, gas demand has increased quite substantially and quicker quicker than initially expected. In Europe, as Morgan explained, that's effectively mainly resulting from the decrease of European gas production, and that's where the perfect storm routes somehow for Europe is the reduction of imports, or the limitation of imports from Russia, Norway, and North Africa for different reasons, and for technical reasons as well. So in line with the different outage that Russia could have faced a couple of months ago, or that Norway would have faced as well a couple of months ago, following the COVID-19 crisis. And last but not least, maybe not that the main driver, but is the historic low oil prices. So back in mid-2021, that basically reduced the gas production, so mainly in the US. And so basically leading to shut-ins of US gas exports, which basically had an impact to reduce the energy supply glut that was present back in 2019 and 2020. So all of these different factors kind of forms the environment or the background of the perfect storm that we are currently facing for the gas market in Europe. Now, interestingly, if we step back a bit and look at, say, the longer term or medium term trends of the gas market, so the current energy shortage somehow that we are facing kind of results from the previous cycle of energy investment, and was already anticipated by energy developers, which basically already started to develop the next wave of energy, which were supposed to come online from 2022 onwards, and have been slightly delayed with the COVID-19 impact. So now the key question is, until when the market would effectively remain tight, and when would the next wave of energy comes online? So not before 2023 to 2025. And what we can find in the different analysis is that gas market analysts are currently betting or expecting a slight reduction of the market tension not before 2024. So when you would have sufficient new energy supply being commissioned, and basically removing the tension on the global markets. And so energy, as seen on the previous slide, the energy is really the key of balancing the different international market, and so that would effectively be the key to address the current market tension. So obviously, Russia has quite a role in Europe to smoothen and to give some additional supplies to the European gas market, but that would not be sufficient to release the global energy market glut, and so to release the global market tensions. So last but not least, on gas price, so it's looking at the recent forwards evolution, so along with the gas price evolution, so in the recent months, and so throughout 2021, so to see how market tensions were effectively factored into the forwards. So what we show on the slide is basically the evolution of the forward curve at different months in 2021. So starting in January 2021, so when the forward curve was pretty flat, so from fresh out of the COVID-19 crisis, and then tracking basically the evolution of the spot gas market, and tracking how the evolution of the spot gas market has impacted the forward curve at different months in time in 2021. So what we can see is that initially, at least until August, so most of the impact was mainly for the 2021-2022 winter. So basically assuming that it was a really short-term market tension that would mainly impact only the upcoming winter. So with only a small impact in 2022, and then no further impact for the rest of the forward curve. So reverting back to relatively low level in terms of gas prices, so between 15 euros and in any case below the 20 euros per megawatt hour threshold. Now, what the market has seen over the last couple of weeks or couple of months is that the current market tension is now effectively traded into the 2022 year, and even slightly in 2023. And recently, we see that the entire forward curve, has factored in some additional premium compared to the start of 2021. So basically reflecting the tension that could effectively be observed in the gas markets, and the fact that effectively the tensions will maybe take a bit longer than initially expected to resolve. So a couple of key factors that effectively explain why 2022 might be effectively, well, would be a key year in rebalancing the European gas market is, well, first, effectively the Norwegian supply that would still have to do a bit of maintenance in Q2 2022, And so that's mainly following the COVID-19 crisis. So some of the maintenance have been delayed to 2022. B is effectively the storage levels. So we don't have any slide on that, but what is really interesting for the 2021-2022 level is that the European storage levels are at the historic minimum in the start of winter. And so depending on the harshness of winter, the level of the storage at the end of the winter would be key. And according to Thieis, effectively likely to be very low at the end of winter. And apart from the European storage is as well the situation of the Russian storage for European markets, which are quite challenging as well. So which have been basically depleted following the 2021 winter and not refilled over last summer as well. So basically raising questions around the storage availability for next winter. And as Morgan showed in his slide, effectively the storage variation is quite key now for balancing the European gas market. And last driver that effectively would be central to rebalancing the European market is obviously the commissioning of Nord Stream 2. That would effectively potentially cool down the European gas market if first, depending on when it gets regulatory approval, and then effectively B, depending on the volume that would be allocated to the Nord Stream 2, knowing that Russia is already flowing gas through the existing pipelines, so across Yamal and the different Ukraine routes and so on. So quite a challenging situation for the gas market. Looking in the short term, we see quite the tensions being resolved, but at a slower pace than initially anticipated. And so the question is effectively by when the gas price would revert back to the previous gas price levels, and when as well the decarbonization objective of the EU Commission would have an impact on the utilization of gas and the utilization of and the pass through of gas price into the different energy markets. Second key variable is for energy markets in Europe is the EU CO2 ETS market that has seen quite a roller coaster as well over the last 2 decades. And more specifically over the last year or so. So to step back as well, as per the other fossil fuel commodities, so we wanted to show a bit more historic data than just focusing on the recent months evolution, and just giving back a bit of background on the recent reforms that impacted the EU ETS. So just as a quick summary of the past phases that we could have observed for EU ETS. So historically, the price was relatively low until 2016-17, and that's because of the significant excess of allowances that was carried over through the different phases. In 2017, the EU enacted a first set of reforms, so the 2018 ETS reform, which led to quite a significant impact on the ETS price and basically led to more than a quadruple increase of CO2 prices, so from a €5 threshold to above €20. So by the end of 2018, with the implementation of a number of additional market features that we won't cover in that webinar, but basically help to rebalance the ETS market. Now, since the previous ETS reform, so new reform has been in the pipe of the European Commission. So basically to align the ETS market with the increased ambition at the EU level, so to further decarbonize the European economy by 2030 and beyond in 2050. So despite the small impact that we can see on the first COVID-19 lockdown, so back in early 2020, so the expected reforms of the ETS, so way before the publication back in July 2021, already led to quite an increase of prices. And so we saw from the start of 2021 an increase of prices. So from the say recent 20-25 euros per ton of CO2 level to somewhere around 40 euros. So before the increase of the gas prices, and since then, continued increase of CO2 price. So basically, to keep gas in the money compared to coal prices, even though we've seen that with the current level of gas prices, the CO2 price has not increased to sufficiently enough to keep gas more economic than coal for power generation. But we see that the CO2 price has increased up till 60 euro or so level recently. And so basically above the initial expectation of the EU ETS reforms, and basically following the trend of increasing commodity prices and mainly gas prices. One interesting note as well is so one of the impact of the Brexit was that the UK would effectively exit the EU ETS, and that could have an impact on the ETS price. So for now, the ETS market has been sufficiently on the upward trend not to reflect any impact of the separation between the UK EU ETS, the UK ETS and the EU ETS. But interestingly, it's kind of the opposite that we've observed in the recent weeks. So it's more the UK ETS market that has shown quite a premium on the EU ETS. So basically reflecting the relatively limited liquidity because the market is quite recent, so dated back from May, and reflected as well the fact that the UK ETS is effectively supposed to be slightly tighter than the EU ETS for the UK market. So a bit more detail on the ETS reforms, but without going into the detail of effectively the key elements. So if we look at just the price estimates done by the Commission at different point in time, we've seen that from the previous ETS assessments that were done back in 2018, and so that were projecting a price of 28 euros in real terms in 2030, we see that the latest estimate from the Commission of different type of reforms and combination of energy policies, because we know that there is any overlap between energy policies would effectively impact the resulting carbon price. We've seen that the range of carbon prices has significantly increased. Interestingly, the upper range of 69 is effectively reflecting a carbon price or energy policies that would use carbon pricing as a central tool to decarbonize the European economy. And so we kind of see that the 69, so the upper range of the Commission estimates, is still slightly higher than the current carbon price. So that the current carbon price is traded within the range of European Commission estimates for 2030. Now, interestingly as well, looking at the further role of carbon pricing into the future and into further decarbonizing the European economy to 2050. So the European Commission do some 2050 energy roadmap analysis as well. And among the different scenarios that the European Commission does and publishes, so the one scenario indicates kind of the business as usual scenario, or the scenario against which the different expected or future energy policies would be assessed. So being the baseline scenario. Back in 2016, when the Commission started doing that so impact assessment exercise, so the baseline scenario was projecting a price of carbon at 90 euros in 2050 in real terms, whereas now the recent baseline scenario, so published in July 2021, is now projected a price of 150 euros per ton of carbon. So in real terms by 2050, illustrating that effectively carbon pricing, even in the baseline scenario, so even in the scenario with just the current energy policies being enacted, carbon pricing would be key to further decarbonize the European economy, and is bound effectively to further increase in the longer term. So now the question is by when effectively we would reach that level, and so whether it would effectively be associated to a lot of emission and only to marginal emissions. But it indicates the role of carbon pricing to 2050. So quite rebasing of future prices. And if we look at scenarios that factor in higher and quicker decarbonization objective at the EU level, so we see that ETS price could effectively reach even higher price level. So between 250 and 350 in some of the European Commission scenarios. In our EPMO modeling, for instance, so the minimum price to further decarbonize the power sector, for instance, would effectively need to reach 300 to 400 euros level. So assuming no further incentives for renewable development, for instance. And so, but you see that in any case, by 2050, the carbon price would effectively be bound to further increase compared to current level. So now the question is, what would be the level of overlap between the different energy policies? And so what would be the role of carbon pricing versus the other policies? But so quite interestingly, what we show on this slide is kind of the available benchmarks that project carbon pricing to 2050. So we see that the different so scenarios from the Commission, so the blue squares and the red square in 2050 show quite an increase of ETS price after 2030, and so putting more so pressure on the carbon prices. And we see that in the recent World Energy Outlook scenarios 2021 as well, which were published a couple of days ago, we see as well that in the announced policy scenario, so the AP scenario or the net zero policy scenario, carbon pricing as well, so along with other energy policies, would be effectively bound to increase quite significantly after 2030, with scenarios that effectively already mentioned price around 100 euros for 2030. So we'll see how it materializes by then. Now that we've reviewed the evolution of the underlying commodities, we can go to the next subject, which is the evolution of the power prices, which would basically reflect what we just described in terms of gas price evolution and CO2 price evolution. We have decided not to spend too much time on the coal price, even though coal price have surged over the recent over the past couple of weeks, and are quite key in some other regions, and putting a lot of pressure on the power supply to the different industries, and even facing shortages. It's somehow less relevant for the European market because, well, the European market have already enacted some coal closure, and it's mainly gas that is marginal in the European market. We can sign out on that. We can find that fact back into historical prices. So historically, the power price has effectively been, well, is quite correlated with underlying commodity prices, and mainly with what we call short-run marginal costs, which basically combines the fuel price and the carbon price into the cost of production for thermal assets. So historically, when a coal capacity was sufficient effectively to supply the European power markets, power prices were in line with the lowest of the gas and coal prices. So as long as CO2 price was not that expensive, coal was effectively cheaper than gas. When gas started to decrease back in 2019, 2020, with the oversupply of gas was effectively cheaper than coal. And now we see is effectively both prices are more or less in line. And despite the fact that over the recent weeks, coal generation is slightly cheaper than gas, power prices are still expected to remain in line with the gas SRMC, simply because coal is not sufficient to balance the European system. And that's kind of follows the energy policies to phase out coal by 2025 in some countries, or even 2022 in France, for instance. So all of that to say that effectively these underlying drivers are the key to assess the evolution of power prices. Now, what we've seen and what we'll see as well, and what we'll present in the last section of the webinar is how the underlying SRMCs of gas and coal, to a much lesser extent, would effectively compare to the evolution of power prices in the longer term, with higher level of renewable penetration. So along the objective of decarbonization, sorry, of the European economy and the power sector. So that's it for the first section, and so we can now go through the second section that kind of review more longer term trends than the short term drivers that we just described. So first is really quite important to assess the evolution of energy markets. So it's to look at energy policies and what would be the key energy policies that would have an impact on the evolution of the generation mix, as well as the demand outlook. So first, as you all know, so the energy sector in Europe would be quite impacted by the European Green Deal, which basically set the scene to reach carbon neutrality in 2050 by combining more ambitious decarbonization objective, as well as new investment plans as well to facilitate the green transition, both in new technologies, as well as depending on the member states. So all of that new European Green Deal and the recent Fit for 55 package that has been published in July 2021 would call for a revision of the previous European energy policies, and would effectively further impact the different energy market, among which the power market. One of the additional policy as well, energy policy that would impact the evolution of the power markets is obviously the coal phase out plans that were already enacted, so in line with the previous 2030 objectives, and would even be likely accelerated as well with the current market conditions. And so we have already seen that, for instance, in Greece, lignite power plants would close ahead of the 2030 phase out date. And we've seen as well that in Bulgaria or Poland, operators of lignite plants as well are considering alternatives to either retrofit, convert, or close their different lignite plants ahead of the initial closure dates. And so we see that effectively the current market condition kind of accelerate the coal and lignite phase out across Europe. One additional key energy policy that would impact the evolution of the European energy mix is the nuclear energy policy as well. And as you might be aware, so that's quite a hot topic at the EU level at the moment, with the EU green taxonomy debate around whether nuclear should be part or not of the EU green taxonomy. In any case, what we see is effectively quite a diverging strategies at the EU level. So with some countries phasing out, some others phasing down, whereas in some Eastern countries, for instance, it's more planning for new and further development of nuclear capacity to, well, basically replace the existing lignite capacity in some instances. Last but not least as well, which would have quite an impact on the evolution of the power mix, is the evolution of the interconnection and the basically integration of the energy markets of the power markets by so alongside the decarbonization of the power markets. And so that's basically factored in 3 guidelines or 3 recommendations by the Commission. So it's basically keeping keep increasing the interconnection capacity. So depending on the peak load, depending on the renewable capacity, installed renewable capacity, as well as interestingly maintaining a price differential between markets to somehow between €2 per megawatt hour, even though we know that historically we haven't seen €2 per megawatt hour being maintained throughout the different European markets. I'm quickly going through the next section on renewable evolution and renewable capacity buildup alongside the decarbonization objective. So what would be quite challenging alongside decarbonizing the power mix would effectively be to keep developing power and wind power and solar power capacities at a sustained and even higher rate than historically. So historically, if we look at the last 20 years, so maximum of solar annual capacity was 22 gigawatts. For wind, it was slightly below 15 gigawatts. And so to comply with the further decarbonization of the European mix, we see that the EPMO analysis show that effectively we would need a minimum of 25 gigawatts of annual capacity for both wind and solar going forward to further decarbonize the European power mixes. One additional side note as well, so the revised increased ambition in 2030 would have an impact in the power mix as well, in the power market. So by basically increasing the renewable energy objective, renewable energy penetration in the power sector from 60% from the previous NECPs to around 64 to 65% in 2030. So further effectively increasing the renewable capacity in the short to medium term, which effectively would need to be translated into the different member state energy policies to 2030. And I will give it back to Morgan on the role of electricity in decarbonization.
Yes, thanks very much, Yves. Do not hesitate to ask your question in the Q&A box in Zoom. We'll answer your question at the end of the webinar or after the webinar. So let's go back to the presentation. Now we'll focus on electricity demand and more generally about final demand, long-term final demand projections. In this slide, we focus on European Commission decarbonization scenarios. So here you have final energy consumptions and how it is shared between the different energy carriers, energy vectors. And what is striking is how electricity will increase its role as an energy carrier in 2050. So this is the sky blue color for electricity, and in 2050 it accounts for between 40–60% of total final demand, depending on the type of scenario, from only 25%, 20% today. So this is a huge increase, which is driven by electrification of heating and cooling, especially in buildings, but also new uses, new end uses for electricity in communication, IT, and then switches from fossil fuel to electricity in transportation or industry. On the top of that, we'll have also development of hydrogen and more generally power to X e-fuels that will add also a demand for electricity. Okay, so if we move to the next slide, please. So now let's go back to natural gas. We start the presentation with presenting why natural gas price has increased so much in the past months. Now let's look forward. So here we have two messages for natural gas in Europe. The first one, if you look at the bottom right corner, you have gas demand, natural gas demand in EU up to 2050 in two decarbonization scenarios. Enerdata is more in line with a -2 degrees limitation in temperature increase, and Energreen and Enerdata is a 3-4 degree scenario to make it simple. And what we can see is that natural gas demand should peak by 2030 or 2025. Now, if we look on the left side, you have global demand, natural gas demand for all regions, and what we can see that EU market will shrink. The relative size will decrease from 10% today to only 5%. So Europe in 2050 should represent only 5% of total natural gas demand. So it means that bargaining power for you will be lower, and it will be in the shadow of Asian markets. So even if we have less consumption for natural gas, it could be still important to some extent for peak power production. So if we move to next slide. So now we go back to electricity demand. Here you have different scenarios for electricity demand for long-term projection, and our scenario, EPMO scenario, is a red curve, pretty much central. And we have different dynamics behind this curve. In the midterm, up to 2030, what we have improvement in energy efficiency, but at the same time, we'll have electrification of end uses. We just mentioned this, new uses of electricity, and at the end, this more than offsets decrease from energy efficiency. So that's why electricity demand will increase by 2030. And then we have an acceleration coming from the development of electrolysis to produce green hydrogen and e-fuels. And that's why it's increasing to 2050. Okay, I will leave you the floor, Yves.
Thanks,
for the
Morgan.
last section.
Yeah, so conscious that we shoot a lot of information and that we didn't have the time to go in depth of the different drivers. So we mainly address effectively the recent commodity prices evolution, and we haven't really had the chance to really review all of the key parameters that structure the evolution of the power markets. We wanted just to show you kind of an illustrative evolution of power prices that we can derive from the EPMO scenarios, and just to show the kind of key 4 phases that we see from the EPMO scenarios. So first, effectively, is the phase that we focused on. So following the recent COVID-19 crisis, which had quite a downward impact on power prices, so reaching historic lows across the different European markets. We've seen that prices have effectively rebounded sharply and now reaching historically highs across the different markets, and in some regions as well, like in the UK, reaching levels never achieved before on a sustained basis. Well, basically reflecting the perfect storm situation, because apart from fundamental commodity driver, the UK market, for instance, faced some adverse political as well as a technical situation, like interconnection outages with the continent, for instance. So all of that to effectively say that recently power markets have faced a quite well the most extreme cycle from historic lows to historic highs. Now looking forward, so with the implementation of the NECP, so that would be a call to be further revised, so in line with the increased ambition, and so with increased renewable penetration by 2030. So we see a progressive decoupling of power prices from underlying thermal SRMCs, and so mainly underlying gas SRMC. And so that's illustrated by the fact that definitely the gray range goes below the orange line, sorry, by 2030, and so that would materialize to different extent in the different European countries. And last phase in the EPMO price forecast is effectively how the long-term power price, assuming the current wholesale power market structure and design, would effectively compare with the SRMCs of commodities, and so with increased renewable penetration and with the increase as well of storage or clean storage technology, either short-term or long-term. And so we see that effectively you would have some sort of a decoupling between the underlying commodity trajectories and the resulting wholesale power price in the different European regions, and obviously quite a decoupling with the coal SRMC. So let me maybe pause here. Thanks for your attention.
Sorry, Yves, just one thing here. Yep. I just want to stress that this view that we have here about the electricity price projection is at European level. So if you want to drill down at country level, it's available in the EPMO European Power Markets Outlook service that we produced.
Thanks, Christian. Yeah, I should have mentioned that effectively. So that's effectively the range of European countries' power prices. And so we would have the price of each single, so not only country, but bidding zones as well, knowing that some of the countries have different bidding zones.
Right, thanks. So, well, thanks a lot, Yves. Thanks a lot, Morgan. I think it's nearly time to wrap up. So let's just take a few questions. And then maybe if we don't have time to address all the questions, we will answer them by email at a later stage. Right?
Yep.
So
short question.
Yeah.
So yeah, I will take two questions. The first one is about why do market participants do not seem to have anticipate this surge, this rebound in energy prices? Why they do not have learned from the past financial crisis and what we could do to prevent this? I would say that maybe this crisis is not exactly the same as the financial crisis. So rebound is quicker. And then in terms of structural effect, I would say that maybe to prevent this, we could support more renewable energy to close the gap between demand and fossil fuel supply. This could be a good idea to be on track on decarbonisation pathways. But apart from that, there are many different, let's say, cyclical reasons that can explain this surge in natural gas prices or coal prices. There was some unplanned outages in LNG facilities. We had a very, let's say, colder than usual winter in northern hemisphere. So many cyclical reasons apart from more structural effect. Then there is maybe if you can complete later on, but before that I would take another question about demand for natural gas demand in Europe. So yeah, I just presented a slide about this. What we expect if we are on track on decarbonisation is to have a peak in natural gas demand by 2030. So exposure to imports should decrease in the medium and longer term, but at the same time, production will also decrease. So the share of importation could still increase even if lower global natural gas demand in Europe.
I think we just have time to the last question.
Yeah, well, on the maybe addressing questions on the power sector. So French versus German forward prices. Well, basically the French power market is more seasonal, present more seasonality to the compared to the German market. And so a higher premium is factored into the French forward compared to the German prices. So even though it would not materialize in the spot market, it could not materialize in the spot market, depending on the harshness of the winter, the forward kind of factor in a slightly higher risk premium compared to Germany. And just to address the kind of rule of thumb question on which drivers is the main player of power price increase. So the rule of thumb is €1 of gas price increase translated to a €2 of power price increase because of the typical efficiency of CCGT. And €1 of ETS price would basically, well, depend on which is the marginal technology. At the moment, given it's more gas than coal, so a €1 of increase of ETS price would translate into a €0.5 of power price increase. And so that basically factor in the carbon content of gas and the typical efficiency of CCGT.
All right.
And maybe just one last comment. Yves, you confirm that the presentation will be available for all participants?
Yep.
Okay, perfect.
I do.
Yes, all participants will be receiving an email with the presentation. Yeah. And also, there's some remaining questions that we didn't have time to address. We'll reply to them by email as well. So yeah, thanks a lot, Yves. Thanks a lot, Morgan. And thanks to the audience for your time. And we'll see you next time, hopefully in another IPMO webinar with further developments on the markets. Thanks, everyone.
Thanks very much. Goodbye.
Thanks a lot. Bye-bye.
Have a good day. Bye.